Welcome to the current federal tax developments for the week of October the 19th, 2020. Current federal tax developments are brought to you by Kaplan Financial Education and by your state Society of CPAs. I'm Ed Zollers, and I'm broadcasting again this week from here in Phoenix, where I've been staying ever since I did my last travel back in, February? Yeah, it was the last time I did it. So I'm still here in Phoenix as we keep going from here, and apparently we'll be here for a little while at this point. But let's talk about what's going on this week. And this week we had a few things happen. First, we're going to get a little bit of clarification about when your PPP loan forgiveness applications need to go in. There was a bit of a panic that ensued as people began to think that maybe they had to get in by Halloween. We'll discuss where that idea came from and also why that's not really what's going to happen. The SBA clarified that this week. We found out there is a deadline coming for if you're going to fax in your NOL carrybacks. Realistically, it's been set up for calendar year deadlines. And what it means is we're going to start mailing in Forms 1139 and 1045 for carrybacks from 2020 returns. We're not going to have a fax line for next year. We also had the IRS quietly appears to have changed their position on the impact of charitable contributions in the computations of QBI. We discovered that in draft instructions that came out this week. We also have a case this week that looks at the issue of when can a taxpayer on the accrual basis claim a deduction for certain expenses. And we'll talk about why the mere fact that maybe you're accruing it, you might even argue that under GAAP you should accrue it, may not mean you're going to get the deduction for tax purposes. Finally, we're going to take a look at the IRS's FAQs. The IRS has been issuing a bunch of FAQs, and this week we got a clear ruling that at least one district court believes that those can be taken to court and challenged at least in a specific circumstance. And that may be good news for those of us who were a little concerned about the IRS starting to just skip giving guidance in any way that was formal and deciding, hey, these FAQs are a great place. We can issue guidance here and nobody can really question us. Well, maybe that's not quite the way it works. Well, let's start, though, with the first issue, which is the one we had come up regarding the deadline for applying for your Paycheck Protection Program loan forgiveness. There had been a bit of a panic brewing ever since Form 3508S came out a couple of weeks ago. And the SBA has addressed that by updating their FAQs. This one is the Paycheck Protection Program Frequently Asked Questions on PPP Loan Forgiveness FAQ. And they've added a question 4 to what's essentially the first section of the FAQ, which goes into your basic forgiveness rules. So let's talk about what the concern was and why the SBA now felt a need to push this out this week. So ever since we got the first Form 3508, the plain vanilla, non-EZ, non-S form, the first one we saw, there has always been in the upper right corner of the form an expiration date. And that expiration date has been October 31st, 2020. Now, back when we got the first 3508 back early on in the PPP loan program, during the summer, nobody really seemed to notice that or care much because, October 31st was, it was after tax season, right? It was way in the future. It was, why worry about that? It's not an issue. So we didn't really have any questions about why there was this expiration date on the application for forgiveness. However, when Form 3508S was issued, and just issued here very recently in October, a lot of people noticed on that form that the expiration date was October 31st. What I found a little bit amusing was that the people that noticed this apparently had never noticed that date had been on the other two forms from day one. But it did lead to a question that people started wondering about. Does that mean that we had to have our applications for forgiveness completed and into the bank by the 31st of October? In fact, some banks have reported to have told their borrowers that they needed to have their information in by the 31st of October, presumably because of this same problem. They were concerned that if they didn't get it in by the 31st of October, that they would be unable to submit it to the SBA. The forgiveness would be denied. So some banks even were pushing on their customers to file this form, while other banks are still not even ready to take the first application. Obviously, confusion reigned. Lots of people got upset. And so the SBA this week decided to put that to rest. In the FAQ, they make it very clear that October 31st is not the last day to file the form. Rather, they say that expiration date was displayed for purposes of compliance with the Paperwork Reduction Act and reflects a temporary expiration date for approved use of the form, that this date will be extended, and when approved, the same forms are just going to show up. The only difference is going to be that expiration date is going to move somewhere further into the future, and it still won't be the real expiration date. The actual deadline, and this is something that was new, we had never really been told by the SBA, what is the real deadline to apply? We had a quasi-deadline. We knew that if we didn't apply for forgiveness by 10 months after the end of the covered period, we would have to start paying back the loan. But it was pretty clear you still could apply after that date. So while 10 months after the end of the 24-week period is a very practical date that we would really want to apply for forgiveness by, so we don't have to start making those payments, the question became, if you miss that date, how far can you go? And the SBA makes it clear in the FAQ that, that deadline is by the maturity date of the borrower's PPP loan. So if you have a 2-year loan, it's when that 2-year period ends. If your period is 5 years, it's when the 5-year period ends. Now, obviously, if you go past the 10 months, you're going to start paying. You're going to pay down some principal. And we do know from the IFRs issued before that if that were to happen, you will actually get that refunded by the bank. So the SBA will pay the bank back that extra. The bank will refund to you the amount of principal that you had paid down. So basically, you still can apply. It is just for that period, though. Some people may have thought, because you were looking for a date, and the statute on these loans is, the statute is 6 years in terms of the time period for review. So some people thought, well, maybe you have 6 years to apply for this. Nope, the SBA makes it clear that 6-year period is after you've given forgiveness, the time period for the SBA to potentially come in and question whether you should have been forgiven. That is not a date for application, so we do know it. But as I said, expect brand new forms to come out, expect them to have a new deadline on them, and expect apparently nothing else very likely will change on those forms. Wouldn't be surprising to see those forms out by the end of the month. Next up, all good things must come to an end. And this is true about the fax lines for sending in your forms 1045 and 1139. The IRS added a question to their temporary procedures to fax certain forms 1139 and 1045 page on their website. They made this change on October the 14th. The IRS had over the summer put in fax lines over which we could fax in any claims for refund. Remember, when these fax lines came in, the service centers were shut down. The mail was piling up at the service centers. And the IRS kind of realized that this whole net operating loss carryback to get money in the hands of businesses who were struggling at the moment was not going to work very well if, in fact, we didn't get around to processing these net operating loss claims until sometime in 2021. So they began to come up with, well, we're going to do this fax system. You remember the first fax system we had was for the Form 7200 for the payments for the payroll tax credits, the refundable payroll tax credit. Now we're going to add it for this. Again, this is a thing they put in mainly for CARES relief. They told us specifically this was not a place to send 1120Xs or any other documents to the IRS. They were going to ignore them there. This was solely for your NOL carrybacks and your minimum tax credit relief. That was part of the CARES Act, and nothing else went to these numbers. Well, now we're going to find out that the IRS said, look, we're going to shut the lines down as of the end of this year. So at December 31st, 2020, these lines will shut down. If we think about this in terms of calendar year taxpayers, this actually makes sense. The due date for filing a claim, for filing the tentative refund claim, the quickie refund, whatever you're going to call it here, the 1045-1139, is by 1 year from the end of the year that generated the NOL that you're filing this form based on. So bottom line, you had until December 31st, 2020 to file your 5-year carryback claim on a 1045 or an 1139 for a calendar year individual or corporation. That is the date we're shutting this down. Obviously, if your fiscal year, there's more time. We're not going to worry about the fiscal year filers. You know, they are going to file in just like the calendar year people. We're not going to worry about it. So if you are fiscal year, you're going to find a date that you have to fax by, and then you'll have some time afterward for which you could mail it in until you get to that 1 year past the year end that generated the NOL. So basically they're saying we're going to take the 2020 calendar year individual returns, 2020 calendar year corporate returns. Those 5-year carrybacks will go back to being filed on paper, not via the fax line. Now, they do mention one quirk here. We have that minimum tax credit rule, plus we have the NOL. And you can do the two together on an 1139 for your corporation to increase your minimum tax credit carryback, etc. But they did point out technically the deadline for that is December 30th of 2020, while the deadline for the NOL is December 31st. If you want to do both together, you're going to have to meet the earlier deadline for filing this, so you can't come in on the 31st and do a combined. On the 31st, you could only do the NOL on that date. You can't do a combined on the 31st. So they do warn you if you have the minimum tax credit carryover, you might want to read the FAQ. The minimum tax credit should say refund. You want to read the FAQ and understand the date that has to be in by, which is different than the date that the NOL carryback has to be in by 1 day. So weird rule, but still, nevertheless, they remind you of that. Now we have something that apparently is coming in quietly under the radar. Well, officially, the IRS, I guess, never told us this in any official form, and now they're unofficially untelling us what they unofficially told us a year ago. An item was noticed in the draft 2020 Form 8895 instructions that were published here just recently on the 9th of October. And in fact was highlighted in an article on in Tax Notes Today on the 13th. And what happened here is we got a draft of the Form 8895, right? That particular form is the form we use for computing our qualified business income deduction. That is the short form. So someone who is below the threshold amount files the 8895 because they don't worry about W-2 wages. They don't worry about specified, SSTB. So they don't worry about the specified service, trade or businesses. That instructions, though, came out this year with one subtle change. And it's kind of interesting. Last year, which became a bit controversial, we were told that the QBI has to be consider all items related to the trade or business. And the instructions said that includes but isn't limited to charitable contributions, unreimbursed partnership expenses, business interest expenses, deductible part of self-employment tax, self-employment health insurance deduction, and contributions to qualified retirement plans. Now, everything on that list really didn't surprise most anybody except the first one, charitable contributions. Are charitable contributions something that reduces QBI? Well, that position was repeated not just in the 8895 instructions. 8895A would tell you the same thing, as did the instructions for what partnerships and S corporations were to report out to their equity holders. They were to be told the charitable contributions. A lot of people got very worked up about this, including a letter came from the AICP asking the IRS about this. Because the question is, the only way they're charitable contributions is that they are not considered to rise to the level of a trade or business deduction under 162. And you may remember the regulations we discussed earlier this year about state and local tax deductions. And we got into that whole question about if a item that looked like a charitable contribution was really a trade or business expense. That got into the whole whether the tax credit rules did or didn't reduce your charitable contribution or your deduction. You may remember we had a nice long discussion going back to the Marquis case about the cases where somebody may make a contribution to a charity that is actually a trade or business expense and is not subjected, therefore, to the charitable contribution limits. If you remember Marquis, which was a case going way back, but it's really the key case in this area. Marquis was a case of a taxpayer ran a travel agency, and she mainly served not-for-profit organizations and specific types of them. And she would make contributions, quote, contributions, to charities that used her services. She would also make contributions to new charities that she thought might use her services. She would decide on the amount of contribution based on the amount of income they were generating, because she's doing this to keep them happy that she's a contributor. But if they're not booking much, she won't contribute a whole lot. And if somebody stopped booking her, she would contribute for 1 year to see if they would come back and then stop. Same thing with the new charities. If they didn't end up booking with her, then she would stop contributing. That was ruled to be a trade or business expense, not a charitable contribution, not subject to limits on charitable contributions. As the AICPA pointed in their letter, the only way something appears as a charitable contribution on the tax return is if it's not a trade or business expense. So, IRS, will you please explain how a charitable contribution, deductible as an itemized deduction, would somehow be related to a trade or business? Well, apparently the IRS has decided maybe we shouldn't answer that question. What happens this year, that sentence that I read you, identical, except it just dropped the 2 words about charitable contributions. No reference to charitable contributions is made this year about adjusting your QBI. Now, that appears to mean the IRS may be changing their position that was officially never stated as an official position, that you would reduce it by charitable contributions. We will need to keep an eye out on other forms. I would assume the 8995A will have this. I also have to assume that we will see those lines dropped from the items to be reported out by charities on their K1s. So that'll be interesting, though, from QBI. So the IRS appears to be quietly changing their position. We do have one court case this week, and it's on, of all things, the all events test. This is the case of the Morningstar Packing Company, LP et al. Versus Commissioner. Tax Court Memorandum Decision 2020-142. The case came down on the 14th of October this year. This case involves a company that is involved in manufacturing tomato-based products. In fact, very big. You're going to discover that they, are really a huge player in the market of processing tomatoes coming from California, which, by the way, if you're not aware, California is by far the largest producer of produce of any state in the U.S. I think, a lot of people would be shocked and they'd probably be picking Midwest. Now, Midwest is not the greatest for growing this sort of heavy-duty produce because it's cold, right? You got a longer growing season in California. So California produces a lot of produce, including a lot of tomatoes. And this particular company, processes tomatoes and converts them into things like tomato paste and other products. Some products go to commercial operators who then use it in their products. Other of their products are like, private branded and sent on. So it'd be like a private branded tomato paste or something of that sort. They would produce those sorts of products. So they do this and they end up manufacturing and working with tomatoes. Well, as you may be aware, if you have any history in farming, that, hey, guess what? Tomatoes grow during a season, and depending on where you're at, that season runs various times of the year. In this case, for the tomato company, right, it ran over the end of the year. Again, we're in California. So their processing period ran through, started, as I recall, in July and ran through into early spring. Now, they're subjected to a lot of requirements, both by their customers and by various regulatory agencies. And so they have to make sure their lines stay up to standard. They also have a big problem. If any part of the line fails, it contaminates the product from that point forward. They have to junk it. And if it stays down for any period of time, you've got a huge problem of spoilage and unable to deliver. So there are huge liabilities for this company, both legally in terms of, let's say regulatory, in terms of, facing fines and other issues from the federal government, from the various states, etc. But then there's also a problem that they wouldn't be able to produce. Now, they already have contracts to buy tomatoes, so if they can't run the plant, they're going to have to buy tomatoes, and it's going to spoil, so you can't use it, they won't produce any product. And the flip side of that is, if you are, let's say, a company that's, let's take an example, that you produce frozen pizzas, you need a lot of tomato product, right? That's going to go into your sauces and other things you're doing. Well, you contract with these people to deliver so much of that tomato product to you. If they have to shut down their line, they're not going to be able to produce that product because, again, they've only got that time period to produce it, and the tomatoes are going to go bad, so there's going to be spoilage. So then they're also going to face, not only got to pay the farmers for all the tomatoes, including the ones they couldn't use, but then they're going to have to compensate their customers for the damages they incur because they are unable to produce product, or they have to go out and buy substitute tomato products on the open market at a higher price. So every time when they get to the end of the processing season, there is significant work they know they're going to go into to bring the line back up fully to standard, right? Have it go back so it's, quote, like new, and then be able to start the line again the following July and for their production season run, okay? So like a lot of people, and I've been around accountants, I know accountants here, and accountants who are not necessarily tax people, but are just accounting accountants, they want to accrue that expense so it's nice and even. We know what people don't like is looking at their P&L and suddenly getting hit with a big expense and not understanding what happened, why wasn't I warned, how'd this happen? So we like those nice and smooth. You learn early on when you're giving copies of financial statements to your managers and to your owners during the year. They're much happier if that statement looks nice and even. Also, if you're a public company, it's nicer if it works that way. So they want to make these accruals and spread it out, and they start accruing it early in the year so that when they actually pay for it, it doesn't nail the P&L, right? So we want to get this out and in front and done. So they've been accruing these expensed all during the season. Now here's the catch. So we've been accruing expenses from July, and we've been accruing them through the end of December. And we're a calendar year taxpayer. We're filing December 31st. What do we do about those accrued expenses on the tax return? Well, the company had been deducting those expenses on the return. The IRS says, wait a minute, we don't believe you have satisfied the all events test. And here's what happens. In order to be able to claim a deduction on the accrual basis, you have to show two things. Economic performance with regard to the item has taken place. And number two, all events have occurred to demonstrate the fact of a liability, and the amount of the liability can be determined with reasonable accuracy. The IRS was disputing on those what's effectively three conditions, even though the code picks them up as two, that they were disputing not whether you couldn't estimate them. Yes, they conceded. The accrual was in line. There's a long history. They know they really got this tied down what the expense is going to be. So that is a reasonable approximation, and in fact, very, very close. They've been doing it long enough. They know how this is going to work. So we don't have any problem with that. They even didn't have problems with economic performance, so the court didn't discuss heavily why that wasn't a problem. They just conceded. Presumably, it may have been a recurring item type election or something of that sort that got it in. But the IRS said, but the fact of the liability has not been established because, you're doing this based on the fact that by the end of the production cycle, the line will be in in shape where it can't keep running and it wouldn't make it through another season. But that's not going to happen till the end, and we don't really know what you're going to have to do, and neither do you, until we get to the end and go back and start inspecting everything and figuring out what's going to happen. Well, the taxpayers claim, no, we have a legal liability already. And they said, and they pointed to two things. They said, look, we have credit agreements that, it's a violation of our covenants. If we ever lose our licensing or ability to operate, we would violate our credit agreements. And we certainly don't want to violate the covenants and have to repay everything right away. And we also have long-term contracts with people like, and again, I don't know that they sell to somebody making frozen pizzas, but let's just assume they do. Like let's say I have this contract with this frozen pizza maker that they use this in their sauces. So I have these contracts I have to be able to deliver or I get nailed with huge liabilities. And I have these contracts from the farmers, right? But the farmers' contracts are on the front end. But that thing's delivered to the pizza company. That is a contract for delivery. I got to be able to deliver. So I have a legal liability, a legal obligation. The tax court didn't agree. The court said, you have a requirement to keep operating, but that's not the same as having a requirement imposed on you to do specific things at the end of each year. In essence, you just need to take whatever actions. This is not tight enough. Neither of these are tied closely enough. It might be different if you had an obligation to, let's say, replace certain parts and to, remove certain things and to do certain specialized cleaning jobs, etc. And that was specified in the contracts. But none of these contracts say anything about that type of detail. They're just very generic. You need to operate. And like they said, the long-term contracts to deliver products, well, that's just a contract to deliver product. That's a very standard thing. And if we allowed you to do that, you could bring everything in under this by accruing anything. So bottom line, the court said, taxpayer, you cannot deduct those expenses that relate to bringing the line back up to standard until the following tax year. May be perfectly fine to accrue it under GAAP. In fact, you can argue you should be accruing it under GAAP. It is definitely a contingency that is probable, right? We can estimate it. It looks great. It looks like GAAP recorded it. But for tax, no deduction, because the fact of the liability is not established until we get to the end of the period. We inspect the line and we find out specifically what has to be done. Understanding these rules are important because one thing I've learned for years is controllers, especially controllers who have accounting training, are going to really want to accrue a lot of things to do this smoothing. You've got to be careful. Not all of that stuff is allowed for taxes because of this very issue. We expect we'll have to incur this expense in the future, but we don't know what it is. And we don't yet, and you can't tell me, I'm going to be replacing this part. I'm going to be doing this thing. And do I have a liability to do it? So be careful here, right? You got to watch this. The company loses this. Again, they eventually get the deduction. That's true. It's quote unquote merely timing, but they are going to be writing a pretty big check, assuming they don't appeal this and win. So just timing can still be very, very expensive. So don't get too tied up with it's just a timing thing. And oh, by the way, the IRS would never question a timing thing. My answer to that is simple. How did this case get to court if the IRS would never question the timing thing? They will. So be careful there, right? Again, very, very interesting case. Finally, this one I thought another case, but this one's interesting, not necessarily for the exact thing decided, although maybe, I know some of you may have an interest in this, but I think it's interesting for people who may reject it out of hand and saying, well, that's okay, I have no clients in incarceration, and none are likely to go there, which, by the way, don't necessarily assume that. For various oddball reasons, yes, I've had a client incarcerated. Won't go into the history of it, but sometimes they do dumb things that are not financial issues or other things. And yeah, things go bad, and suddenly you discover you're talking to your client at the state pen. It's like, how'd you get in there? It's like, well, this happened. It's like, you did what? Yeah, okay. So anyway, right, it can happen. Just saying, it can happen. Don't normally find my clients in the state pen, but did have it happen. So yes, don't assume it never could happen. So here we go with this. This is Scholl et al. Versus Mnuchin et al. Okay, and Mnuchin in question, Steve Mnuchin, Secretary of Treasury. So really just suing the Treasury Department. It was decided in the U.S. District Court of the Northern District of California. It's case number 4:20-CV-05309. It was published on October the 14th. And where this comes up, remember we talked about earlier in the program, this was actually last year, that the IRS had stated they were going to stop issuing and greatly reduce the issuance of quote-unquote sub-regulatory guidance. Now, theoretically, the reason why we wanted to do this was because sub-regulatory guidance, regulations have to have these comment periods and discussions back and forth, and sub-regulatory things like notices, revenue procedures, and revenue rulings don't have to have that sort of period. So they said, well, we're going to stop issuing that kind of stuff as often as we used to. Mainly issue revenue procedures, issue many less revenue rulings or notices. All well and good, but remember, the IRS was also told that if you issue a new regulation, you have to remove 2 others. Remember that rule? So bottom line, they're not going to issue new regulations. So it's not as if we were going to get rid of sub-regulatory and go over to regulations with the full comment period. So what were we going to do? Well, we discovered quickly the IRS discovered their web page. And they discovered publishing these things called frequently asked questions, FAQs, right? And that history of that term goes back to, actually, I think it was internet news groups, the old news group systems, which, yeah, you have to be really way back, and it's an internet standard. That was a big thing back in the very, very early days of the net. But that was the first place every group would set up its FAQs, which was meant to stop people asking the same question when they came to a group every time. And these groups are on lots of topics. Eventually, it kind of devolved as other mechanisms evolved and other things happened. It finally devolved into news groups, became mainly homes for, let's say, less than appropriate for work type items, shall we say, wildly not appropriate. It was a pornography area, as well as pilfered software. Yeah, it kind of went downhill. But that was where the FAQ started. And so then we got FAQs posted on website. Frequently asked questions is what it stands for. And what the IRS started doing after they said no more sub-regulatory guidance was they started hitting these things on the websites with FAQs. I had complained previously that that's going from, not great to horrible. This was not an improvement cutting sub-regulatory guidance when the alternative was we're going to start putting things in FAQs and in instructions, just like that charitable contribution issue we discussed earlier. So in essence, instead of issuing things in the Internal Revenue Bulletin that we know about, we can find, and by the way, we're much more likely to yell about, yes, we might not get input ahead of time, but certainly it's going to come up to a head much quicker if it's in the Internal Revenue Bulletin because we're told taxpayers can rely on it. That's the other key. The FAQs we can't rely on, but yeah, so the IRS is not bound, but it's like, yeah, totally different mess. I hated this. I thought it was a solution that works great in other agencies. That is a horrendously bad and awful solution for the tax rules, and I've said that from day one. I still buy it's an awful solution. And the good news is the courts now are kind of agreeing that IRS, we're not going to let you actually get away with something here, at least in this area. Now, the question in this case, you probably have heard about it, was whether the IRS had the authority to determine that the economic incentive payments, the $1,200 payments, that those could not be made to individuals who were incarcerated. Right? The IRS added Q&A number 15 in May on the payments stating that they could not be made to incarcerated individuals. And in fact, that if they had received it, they have to send it back. The IRS actively went to the prisons to tell them if they were still holding the funds for the incarcerated person, they had to send it back. The agency stopped sending it. Now, as more than a few of us noted at the time, it's like, well, yeah, that might be. And yes, it could be a big fraud thing if you allowed them to file for it, because There might be some fraudsters in prison who would file. Yeah, it could be interesting. It's like, that's all great, but Congress didn't say anything about it. You're basically trying to patch a congressional foul up at best, is the way you'd view it. But there's nothing in the law that allows you to do this. But the IRS never put it in the Internal Revenue Bulletin. They didn't issue regulations. They never told us why they did this. They just did it in the FAQ, and they started, taking action based on that. Now, certain parties started challenging this, representing incarcerated individuals, and the IRS said, sorry, guys, you can't challenge it. It's just an FAQ, right? It's not something in the Internal Revenue Bulletin. It's not a regulation. It's not this issue of a final agency action that could be challenged under the Administrative Procedures Act. The court rejected that view. We already kind of knew it, but now we got the formal opinion to back it up. They issued a preliminary injunction requiring the IRS to pay these out, and now they've gone and made it permanent, right? They've given summary judgment in this case. And they said, sorry, IRS, you cannot use FAQs to get around the Administrative Procedures Act. You have to be able to do this. Now, basically, the court said, here's our big problem. The Administrative Procedures Act allows you, in certain cases, to take action against the agency, to overturn a decision. And so they took a look at a few factors here. Generally, in order to have this for the Administrative Procedures Act, right, you have to have all of these issues, right? That in order to make this go, we're looking to sort of carry on whether or not we can do this. First, we have to have a final action in a decision-making project from an agency. It has to exist. And there has to be essentially no, basically, there have to be legal consequences, which there are, and there has to be no other method for the taxpayer to challenge this issue. The court said, IRS, here's what happens. This is an action of you. It is a final action. They claim, no, it was just temporary, and oh, by the way, they get a refund next year, et cetera, we're fine. They said, IRS, you're crazy. This is not how this works. When you do something like this, you are hitting the payment which Congress told you to make as fast as possible. You're reducing it this year. You just came out and did a fiat ruling. That is, you simply said it can't be paid them with no explanation about why it couldn't. They said there is a requirement that you explain the reasons behind. Go from the law to your ruling to tell us how you go from the law to your holding. There is nothing whatsoever in the FAQ. Nothing was published at the same time as the FAQ. There was nothing out there. The first explanation we got from you was when the suit was filed and you had to respond. And IRS, that's too late. You have to tell taxpayers why this is your position at the time you take it. Also, there are consequences. Remember, this was payments to be made to people for immediate economic relief. Getting a refund in 2020 is not the equivalent. Getting a refund on your 2020 return is not the equivalent. Yes, they recognize some people wouldn't qualify. They might qualify later. That was a backstop provision. That was not the main provision. So don't tell us it's there. And the court said, number 3, even if it's there, your position is still they can't get it. So they would have to file a claim for refund for $1,200. And you would deny their claim because you're going to follow this. And you already told you've already in your administrative documents, your documents, in the revenue, the IRM, etc. You've already taken the position they're going to deny this. So they would have to file a lawsuit in federal court. It's not economically viable to go to federal court to challenge for $1,200. That's not at all practical. So there is actually no real way to do this. Because you didn't explain, your action was arbitrary and capricious. The court said, we don't see anything directly in the law that's unambiguously in the law says that they wouldn't go there. In fact, we don't see anything in the law, period, about it. We're not going to take your after-the-fact explanation at this point. You've got to go back through an entire process to do it. Sorry, guys. So, and don't tell us that FAQs can't be challenged. Now, I think the really good news for us out of this is not so much, okay, maybe if you're incarcerated, you get $1,200. Great. And I'm sure that that's a big deal. I'm not going to say it's not, but I think for most of us without, or at least for most of our clients who are not incarcerated, the bigger deal is that the IRS has been told flat out that they can't hide behind FAQs and not have to defend their actions. Because, yes, we all know that even though the FAQ is not official, even though it's technically, it's just their musings online, the reality is that we know 99.99% of the time the IRS is going to go ahead and follow the FAQ, right? Whatever it says, that's what they're going to do. Your client would have to challenge that by going to court, right? Which is going to be very, very expensive. Number two, your clients tend to not want IRS exams, period. So when the IRS makes these statements, it means for 99% of the taxpayers, whatever they say in the FAQ is going to become the law the taxpayer will for practical purposes, have to follow. Now, I know I have at least one attorney that's going to be upset because they're saying, no, this isn't official. I can't believe CPAs pay attention to that. It's totally unofficial. I agree. It is unofficial. But the reality is you've got to tell the taxpayer that the IRS will probably reverse this if it's challenged or if it's examined. And while I understand as an attorney, it's like, well, then you just take them to court and you win. I don't recall any attorneys who have that objection ever telling me, and I'll take it to court for free for all of your clients. No, as this court points out, for those who are incarcerated, it's going to cost to go after that $1,200. And therefore, sure, if we're talking about something that impacts you and it's a $500,000 amount of tax, yeah, I'm going to court. But we're talking about things like this, or frankly, things like charitable contributions being part of qualified business income. There's no way it's going to make sense to take that to court to challenge the IRS. Even tax court, which, by the way, in this case would not really be available in many cases, unless the IRS paid it out and then tried to get it back. Basically, it's just not feasible. The cost is going to be too high. So the good news is it does appear this court's logic allows us to go after the FAQs. And what's more interesting, the IRS chief counsel was quoted in a tax analyst article just a few days earlier that they're considering maybe it'd be okay to publish these FAQs, some big ones, in the Internal Revenue Bulletin so they're officially published out there and we're subjected directly, or even convert them to notices and go with, hey, that thing, subrogatory guidance we're allowed to have, maybe we should do some of that on these things. Yeah, IRS, maybe you should do some of that on these things, like on all of them. Well, okay, maybe not all, but certainly the ones like this that come out of left field, things like the charitable contributions for QBIs. Why? Explain to us your position. Give a reason. But when you just come out and say it, and then say, and you can't challenge us in courts, you got to wait for us to disallow and then go all the way through tax court, etc., that we can't have organizations get together and file a complaint up front as a group. Yeah, that's not going to fly. So I'm hopeful that this gets the IRS to quit trying to use FAQs as a way to work around having to take an official position on anything, but still be able to impose their will indirectly. We'll see how that goes. Hey, we've got some upcoming courses now because, hey, it's past tax season. And actually for this week, I'm doing a couple of in-firm courses for firms that have booked us. So by the way, we do that. So if you want to have us do one, you can call up and book us to do a tax update for you for the year. We can do those 4 hours, 8 hours. Obviously, this year, for the most part, it's being done remotely because of travel restrictions and other problems with COVID. But you've all gotten pretty used to doing things online. If you're listening to this, you're at least somewhat used to listening to things online. So we're still doing that. But I do have the standard state society courses too that you all can sign up for. The Idaho Society, I want to remind you, on the 29th and 30th of this month, I've got two courses, one preparing complex 1040s and one on fringe benefits. So those two courses. Complex 1040s will look at things like 109 Cap A issues, NOLs, the business loss restrictions that will come back at us in 2021. all of those things on your complex return, past activity loss problems, all those fun, neat things. Fringe benefits, going to look at things like the Secure Act, their impact on profit-sharing pension plans, where we sit on medical insurance issues at this point, and all of those nice details, and maybe some speculation about, if the Supreme Court were to rule in favor of the states on the Affordable Care Act issue, what exactly is likely to disappear or not disappear in that case. Yeah, all kinds of issues like that. Also have coming up a couple of conferences will be part of. And before somebody notices, yes, I realize these two conferences are at different locations and they're going on the same day. Well, first thing is, it is the miracle of Zoom, shall we say, that takes care of this. In fact, in both cases, although I guess actually one is Adobe Connect, the other is going to be Zoom. In any event, we're going to be running it that way. On the 4th through the 6th of November, the Arizona Federal Tax Institute will go on. I will be doing two separate sessions, one on the 4th, one on the 6th. On the 4th will be a federal tax update for cases, rulings, etc. that aren't COVID relief items. And on the 6th, I'll be doing a session that talks about the COVID relief items we had this year. I'll also be doing a session for the Washington State Society of CPAs. And that will be going on the 5th and 6th, the Pacific Tax Institute. And there I'll do a session on the 6th on the CARES Act impact on net operating losses, as well as the taxation of debt forgiveness. And we'll be doing both of those sessions. So, tune in if you want, take a look. And by the way, you can sign up at those state societies. You can contact me as always, Ed Zollers, currentfederaltaxdevelopments.com. We do post on the www.currentfederaltaxdevelopments.com website or updates constantly. My Twitter handle at Ed Zollers, so you can find me there. I also monitor the state society websites for certain states, their Connect sites. So I do that for Arizona, Illinois, Minnesota, New Jersey, and Washington. Follow at least some of their Connect groups there. So if you have issues or questions there, you can post. Very useful resources where you can find especially things about state law issues, because obviously there aren't a lot of good resources for most state law issues. If you're in a relatively large state, there are limited resources. You have to be a state like the size of California before you get specialized companies that only do the state taxes like Spidell, that are state tax focused. So for most of us, we have to kind of, for state taxes, hopefully do some back and forth in between with each other. And these state society groups are very, very useful for that kind of back and forth. Again, be back next week. We'll take a look, see what we got. Hey, they're talking about a stimulus. They're talking about a stimulus bill again. Yeah, I'll believe it when I see it. But if they actually pass one, we will talk about that whenever they do and whatever they do. I like this on again, off again, on. It's like I've lost track of how many times we've said yes, no, and forget it on this. But apparently they're still talking, so we'll see what happens. So be sure to join us next week, and we'll bring you here for more things happening on the area of current federal tax developments and the post-tax season. And get ready for tax planning meetings, time of the year for all of you here in taxes.